Hi guys, welcome to Gold Today. This video is brought to you by the coach. Remember always our job is to make you rich. If you are a new subscriber, welcome aboard and thank you for joining us. If not yet, please hit the subscribe button. We are going to start our video with the economic calendar. On the economic calendar for Friday, and from the United States, we will be waiting for the following economic headers to be released. Fed Powell speech. This is highly important. Then we'll be waiting also for the new home sales for month of July and the new home sales month to month for month of July. And we will be waiting for the Jackson Hole Symposium for more comments from the central banks, governors from around the world. That's all for the economic calendar. We'll move on now to the numbers. On the last trading session of Thursday, we have had a trading range from 1492 to 1504. Numbers are rounded and the market is still open. Gold spot is expected to print a close price above 1500. The number is rounded and the market is still opened. Gold is trading in a bull trend above its all daily simple moving averages. What matters for us is the 20 days daily simple moving average is about 1489. And the market is completely bullish if we are still trading above 1447. We are overbought on the weekly and monthly charts with high readings, and for the support levels it's 1490 followed by 1481 and then 1442, and for the resistance levels is 1511 followed by 1518 and 1527. That's all for the numbers. We'll move on now to the trading strategy. The first phase of the paradox started in 2008 when the Federal Reserve Bank, following the financial crisis, printed about $3.8 trillion and injected them into the financial system through the banks to help the economy comes into shape again. Then the Federal Reserve Bank started what they call the tightening policy to withdraw this excess of money out from the system, as it's going to inflate the system. The cycle should have taken interest rates back into an average of 6% through several rate hikes, and the tightening cycle should have rendered a very strong or a stronger US dollar, a healthier economy, and if it happened to be completed, it should have sent gold down to 900 US dollars or below. The tightening cycle did not reach its proposed end. It was actually ended in the last July, though the Fed did not say it clear if they're going to have an easing cycle to replace this tightening cycle. However, the reason for stopping the tightening cycle was simply due to the fact that the US economy have shown some signs of exhaustion. The point which I'm trying to make it clear for you, they did not stop it with their own will. They were forced to do this. Because without stopping the tightening cycle and starting an easing one, the imminent recession will hit since the debt is sizable, and it's going to be a recession that will send half the Americans back to homes without jobs. Being honest, the Federal Reserve Bank did not say that they want to start easing. All what we can say for now, they wanted to pause the tightening. But in the world of finance, there is nothing called pause. There is either you give or take. The other face of the paradox is that we got a president who wants to be re-elected again, and a huge country which needs to spend. Simply, the government needs money, and they want to issue more debt and want to print more money to finance their deficit and to deliver what they have promised their voters. So they want easing. Now the paradox. The Federal Reserve Bank has two options: either to bail out the government by lowering interest rates, dipping into easing monetary policy, and printing more money, injecting it to the system, and the only one risk is that the inflation is going to hit the pockets of the Americans. Other option is to bail out the US dollar, keep it strong, continue tightening, and by that you will put the country into a face with an imminent recession. The point is the Federal Reserve Bank is not in place to make a choice. Technically, gold is trading in a bullet trend. I said we are into a correction as long as 1534 is not clear yet. Avoid the temptation of shorting, but since we have had lower highs and lower lows, maybe there will be a pullback to 1490 or 1481. But it's not advisable to short, but if you want to short with a stop loss at 1511. This market, which has so many reasons to rise, it could rotate $20 at least in a blink of eye. So I don't favor actually the idea of shorting. Look for a dip at 1490 or 1480 or 1450 is better for you. The US equities and the US dollar are both on the, on my opinion, on a live support, and what you see on the screen of firmness and could change in a moment. Also, you don't want to be in the risk for that. Keep your exit close in case you did any buy dip tomorrow. Now you have seen today that gold needed 14 hours to reach to 1492 from 1503, and in a 1 hour made it back to 1503 and printed a new high at 1504. The market is bullish and it's strong, and it's meaningless to short it at this point of time. Also, as I'm making it now like a daily reminder, please keep a good relationship between your margin requirements and your equity. This is the mistake that most of the traders falls on when they want to just catch the chance, and they want to become millionaires overnight. This is not happening in this market. Don't overload your account and build your own position, as I say always, in gold and silver. Benefit if there is any dip with a close to buy some physical gold and silver and make your own position, which I believe you are going to really need it in the future. That's all for today. Thank you guys for watching. I will see you tomorrow or day after tomorrow, another video.